I think the key message is that we've been in a kind of a super cycle of low defaults for some time. I think the kind of creative destruction regime has been thwarted by heavy intervention in the last 10, even to 20 years. So we went into this crisis with pretty low defaults relative to the economic outlook. And that's really because, excuse me, we got so much debt in the system that the authorities are nervous about seeing widespread defaults. And then COVID-19 comes along, and the authorities get even more nervous about the huge debt burden. And some of the policies that have been put in place in the last 8-9 weeks to prevent defaults have been extraordinary. So we are going to see the worst economic slowdown for maybe 100 years and 300 years in the UK. And yet defaults will probably get to a normal recessionary level in the US and probably less in Europe, where the high yield market is probably higher quality. So defaults massively suppressed relative to the economic shock to come, I think is the key message.
And it's really fascinating when we think about what all this means. The fact that ultra low interest rate environments have kept low, sometimes negatively profitable companies going for a lot longer than they would have otherwise. And now with the pandemic, they're getting even more stimulus from governments. What does this all mean for creative destruction? The fact that all these companies that perhaps shouldn't have been kept alive are going to continue to be kept alive in the future?
Well, I think, as we show in the report, there's a pretty good correlation between default rates and productivity. So productivity is normally higher when you've got more defaults through a cycle. So if you continually stop the natural default process where the weakest companies default, you tend to get a lower productivity outcome. And I suspect that the COVID-19 shock will be an extreme version of this. So, in keeping companies alive where, unfortunately, their business model is impaired, will probably mean lower productivity going forward.
Jim, the take on the world that you have is very bearish broadly for risk assets, but will encourage investors to continue to seek some safety and return in treasuries. And yet, yesterday, when we had a bit of a breakthrough around Moderna and some healthcare news, it was the Treasury market that got hit alongside gold and some other perceived safe havens. How carefully do you have to negotiate your sovereign holdings given we get these big whiplash reversal days?
Yeah, I mean, I would say our outlook isn't particularly bearish in markets because we've got an extraordinary central bank. I mean, the Fed have already pumped in more stimulus in the first 8 weeks of this crisis than they did in the first 4 or 5 years of the financial crisis. So we're getting kind of 4 and a bit years compressed into 8 weeks in terms of stimulus. So that is keeping us, relatively neutral, I would say, on risk assets. I suppose the biggest problem if you're a treasury investor is not so much your nominal returns, because I think that central banks are going to do everything to keep yields low. But I suppose it depends on your take on inflation. If you think that there is going to be inflation because of this, then buying bond yields somewhere around 0.5% in the US and negative in many parts of Europe is probably not going to be a great trade. But I think the nominal yields will probably be capped by aggressive central bank buying in the months and years ahead.